Hello, my name is Mark Prather, broker of Mark One Real Estate. Today I want to talk to you about American crisis. The crisis I'm referring to has to do with Americans and their ability to retire. Most people aren't aware, but the majority of Americans will never be able to retire. There are several reasons for this that we're going to talk about. One has to do with the number of companies that have eliminated their pension plans. Today, 78% of private American companies no longer offer any type of pension plans. That number is continuing to grow, meaning fewer and fewer people are having pension plans or retirement programs. So what does that mean? Well, that basically means you're on your own when it comes to retirement. I want to share with you some scary statistics about Americans' wealth. 46% of Americans have less than $10,000 saved. 29% have less than $1,000 saved. And 25% have absolutely no savings at all. I'd like to share with you a few questions for you to ponder. First, will you be able to retire? And second, do you know what to do in order to achieve your retirement? Most people live in denial of these questions. They never consider what the challenge is in front of them. We're going to discuss that and show you the steps necessary so that you can achieve financial security. Why the rich stay rich and the poor stay poor? You've probably heard that over the last 30 years the gap between the rich and the poor has grown wider today than it has ever been. But why is that? What's changed in America, and what's changed when it comes to being able to accumulate wealth for the middle class and the lower income families? And what can we do to improve that situation? Well, let me share with you the big challenge that impacts all of us. What that is inflation. Over the past 100 years, the average inflation rate in this country has been a little over 3%. Now, why is that? Inflation is a byproduct of the government. The government, by design, I'm sure you've heard of the Federal Reserve, by design wants inflation. Inflation creates growth. Now, the other side of inflation is controlling the inflation. And inflation is something that you can see through the years, how inflation rates have accelerated and declined. And what we've been fighting recently is a deflationary period. But inflation is something that is a reality. It's always been here and it will always be here. Now, the next part of that is our wages and our income. If you look at the average income increase for the average employee, it's been about 3.7% in wage increases. If you compare that with the annual inflation rate that sits around 3%, you can see that it's virtually impossible for this person to get ahead. The people that are wealthy have assets. They have homes, they have investments of all types, whether it's stocks and bonds, they have investments in property and real estate, apartment units, and so on and so forth. The average person has little or no investments. If you do not have investments, or you have what are called depreciating assets, it's impossible to get ahead. And in fact, you're going to fall behind inflation, and it's almost impossible to save enough money to be able to retire. The only chance that you have, that any of us have, to retire successfully is through asset accumulation. 3 questions that you need to be able to answer in preparing for retirement. The first is, what will my monthly expenses be when I'm ready to retire? This challenging question confuses many people. When I think back to when I was 18 years old, which was 40 years ago, my first apartment I rented was $315 a month. If someone would have told me today that same place would be renting for $2,500 a month, I would have not believed it. And that's typical of what most people experience, is they look at their current experience, their current lifestyle expenses, and trying to project what those expenses are going to be 20, 25, 30 years is very difficult. And 99% of the time, they grossly underestimate the increase of what those expenses are. So that's the first hurdle, is understanding what inflation is going to do to your current expenses and trying to have that same lifestyle. So that's the first challenge. The second challenge is in understanding what your monthly expenses are going to be at retirement is how are you going to generate the monthly income to cover those expenses. And the third question is how much in assets that you need to acquire, how are you going to acquire those assets? The number that you're going to need in assets accumulation, when you start to do these calculations, is substantial and in most cases quite shocking. We've created a Mark I retirement calculator that within 60 seconds will crystallize where you need to be, taking what your current expenses are, where they will be at your time of retirement, again, whether that's 15, 20, 25, 30 years, how much monthly income you're going to need to cover that, and what you're going to need in asset allocation. We all want to accumulate as much wealth as we can, as quickly as we can. So let's examine how we can do that best. There are different ways to save money. You can have it in your savings account in the bank and get today probably a 1 to 1.5% rate of return. You can invest in stocks and bonds. You can invest in real estate. We're going to analyze each one. The chart you're looking at here is a history from 1990 through 2014. It's a 24-year history of the Dow, or the Dow Jones Industrial Averages. And what you can see is in the early 90s, the rate of growth in the Dow was minimal at best. There was a recession, for those of you that remember in the early 1990s, it wasn't until the mid-90s that the recession started to fade and we started to have growth. And through the 90s, the stock market steadily grew. There was a dot-com bubble, there was a slight little dip there, and then back to the races, and the market raged and grew all the way till 2008 when we had the market meltdown, we had the big collapse. Since then, over the past 5 years or so, we've seen the stock market fully recover and beyond. So the Dow started at 2,000 in 1990, and today it's been ranging in the 16,000 to 17,000 range. Okay, let's discuss the real estate market. In 1990, the median price for a home in Los Angeles County was $200,000. If you look at the chart here showing the appreciation rate of how property values rose, very similarly to the stock market, is in the early 90s, again, there was a recession. Property values pretty much went sideways. In some areas, they even went down 1 or 2%. But in most areas, it was pretty much a flat line for those recessionary years. Then in the mid-90s, the economy started to improve. Property values started rising, and they kept rising. And then in 2001, you can see it just continued to go. There was no reflection with what happened in stocks with the little dot-com bubble adjustment. But property values kept rising and rising and rising. Then 2008, economic meltdown, the financial turmoil, property values dropped pretty significantly. And then the recovery. And continue to recover, where as of today, we've fully recovered from the meltdown, and property values have risen for where the median price home today is in excess, in Los Angeles County, in excess of $500,000. But what I want you to note, if you look at the two slides comparing the Dow to the real estate market, they mirror each other in a lot of ways. They're not in lockstep, but they mirror each other in many ways. And the reason for that is they are both tied to the economy. When the economy is strong and growing, both rise. When the economy is suffering, when there's recessions, they both suffer. But from an investment perspective, they are very similar in that area. But when it comes to rate of return and your ability to accumulate wealth, it's a much different story, and I'll share with you that. All right, let's compare the Dow to the real estate market. In 1990, if you had invested $12,000 in the Dow, you can see that over a 24-year period, that $12,000 would have grown to $81,000, achieving a return of about $69,000 and a return on investment of almost 22%. But if you had bought a home in Los Angeles County for $200,000, which was the median price for a home, put $12,000 as your down payment, which would have been typical on an FHA loan, that property 24 years later would be at $486,000, and today we know it's even higher than that. The total return in dollars and cents is $273,000, or a return on investment of 137%. When you look at it in dollars and cents, the return to you is over 4 times more through real estate. Why? What is the reason for that? Well, it's on line 2. If you look on there where it says investment value, here's the big difference between real estate and typical investments in the stock and bond market is that if you invest in the Dow, your $12,000 has a $12,000 investment value. When you purchase a home or when you purchase real estate, very seldom do people pay cash for real estate. There are some of those, but in most cases, people put a down payment. FHA is 3.5% down. They may put 5 or 10% down. In this case, where we use the $12,000, it's an FHA financed home. So instead of having your rate of return tied to the $12,000, it's tied to your asset value, in this case, which is $200,000. So when you're looking at a rate of return on $200,000 as an asset versus a rate of return tied to a $12,000 asset, you can see that's what creates the significant difference between real estate and the stock market. The real estate has what I call an unfair advantage, and that unfair advantage is called leverage, because of the fact that your rate of return is tied to the asset value. Leverage is, and this unfair advantage, is the fastest way to accumulate wealth. So why haven't you heard this financial advice before? Well, here's the reason. What I learned over my career is when I was younger and started making some money, I sat down with a financial planner and started laying out a financial plan. And for those of you that have worked with a financial planner, I'm sure you had a very similar experience. We talked about some of the factors that I mentioned early on as far as what my current expenses were at that point, what we projected them to be, how much do I need to save and set aside for investments. But we only talked about investing in things like stocks, bonds, mutual funds, and annuities. See, investment planners, financial planners, investment bankers, they sell these kinds of products. They do not sell real estate. They don't focus on real estate. They are not professionals in real estate. They are experts in the other investments. And so they only talk about the other investments. And the conversation about leverage and how real estate can work for them, they don't discuss that because it's not their expertise. Now, in the real estate field, why would you have not heard of this from a real estate agent before? And here's the sad truth, is that most realtors, and when I say most, 99% of the real estate industry is not taught these investment strategies. The 1% that are is the agents that specialize in commercial real estate, because commercial real estate is investment real estate. But in the residential world, the agents are not typically trained in these areas. What we're teaching here at Mark One through our Mark One Wealth Academy, these are investment decisions that I've learned over a lifetime of accumulating assets and investing in various assets, and the power of leverage and what that can do for you. With us at Mark One, our objective is to be your investment planner. It's to help show you a strategy step by step on how you can accumulate the wealth that you will need to achieve the monthly income to cover the expenses that you're going to have when you reach 62 years old or 65 and you want to retire and have that financial security and have a peaceful life. At Mark One, our objective is to be your real estate investment consultant. We will teach you a 3-step process of how to accumulate millions of dollars worth of assets. Now, for some of you, you might think that just seems unrealistic, but I can promise you that we can show anyone that has the ability to buy a home, starting off with a first-time buyer with only 3.5% down payment, how over a 20-year period they can achieve as much as $4 to $5 million in assets. Now, if you don't believe that, that seems extreme. I'm telling you, it is not It is very factual. We will show you step by step how to achieve that type of wealth. And of course, if you have higher income levels and you're able to buy more expensive properties, then those numbers grow from there. But mark one, sit down with one of our representatives, and we will show you a 3-step process to achieve millions of dollars in assets and to secure your financial security. Thank you. I appreciate your time.